Hi everyone, welcome to YX Insights. Today is November the 8th, pre-market open. We just had a big week this week with Trump winning the US election, stock market popping, and then the Fed cutting 25 basis points into an all-time high in the stock market. So in the FOMC, Powell essentially dismissed that the recent surge in yields was driven by inflation expectation. And instead, he would favor the narrative of upside surprises in the economic data, as well as strong economic growth in the US. If we look at the charts here, we have in the red is the 5-year break-even, which is an approximation of the market pricing for the 5-year inflation, which compensates for the bondholders. And in the blue here, we have a 10-year Treasury yield, which has been essentially rising up and up since the last FOMC. So you can see that the spot inflation, spot to 5-year inflation expectation, and the yields are going in the same direction. And in fact, the inflation expectation probably rose a bit more, even more rapidly than the yields itself. But what Powell is saying is that the Fed doesn't just look at the 5-year spot inflation expectation. They actually look at the 5-year forward inflation expectation. So what the 5-year inflation is being expected 5 years from today. And we can do a rough calculation for that using the 10-year inflation break-even versus the 5-year break-even. Right. So what we're seeing is that the Fed is right about the forward inflation expectation actually being coming down a little bit since October, and so has the oil prices. So the lower energy prices have more corresponded with the forward inflation expectation rather than the spot inflation expectation. And we can sort of gauge a couple of things from here. So I think up to the market started to price in a Trump win, not just in the betting markets with over 60% odds leading up to the election, but also yields and spot inflation expectations both have been going higher. And if you think about the fact that Trump will only be in the government for 4 years, it would make sense that the market expects the spot 5-year inflation expectation to rise during the 4 years Trump is in office, and then would fall after that. So I think that's the dichotomy we're seeing between the spot measures and the forward measures. So what the Fed also has said is that they're actually quite comfortable with where the 10-year yield is right now and where the inflation expectation is as well. They would begin to be more worried if the forward expectation becomes more anchored at a much higher rate than today. So we haven't quite crossed that threshold for the Fed yet. So overall, the Fed wasn't that dovish, and I think potentially in December they could even have a pause. And I think this. So the market currently prices in about 60%. Chance of a cut in December, which we'll see in a second. But I think that overall, the way the Fed has cut 50 basis points in September, which is a quite big rush, now saying there isn't a rush because the economic data are better since 2 months ago. It just feels they're a little bit, they have quite a bit of a recency bias in their decision making. And they're not committed to what they're going to do in December yet, because they want to see another 6 weeks data up to that point. Just looking at the NFP, we had essentially the worst non-farm payrolls in the past 24 months. It's largely due to labor strikes from the ports and hurricanes. And however, because participation has also gone down, the overall unemployment rate essentially stayed flat from the month before. And the Fed actually cited this decrease from 4.3% unemployment rate to 4.1% unemployment rate as a solid improvement in the labor market. So they're quite happy as well. Again, it suggests the overall stance is less dovish than what we might have thought back in September. And the rates market probably will take this as higher for longer. The Fed also says the labor market is not a source of inflation. But the thing is, we had rising hourly earnings on a year-on-year basis of 4% in the past month and 3.9% in the month before. And these are quite high figures compared to the overall inflation target of just 2%. And if you look at the annualized, 3-month annualized basis, which is a quicker measure of this underlying speed of earnings acceleration, is now actually above 4.5%. So it's actually in a quite strong upward rising trend since spring this year. And actually, contrary to what the Fed says about the labor market not being a source of inflation, it actually is in terms of historical performance. So if you look at the historical relationship between hourly earnings and core CPI, it shows a quite strong correlation between higher core CPI and high hourly earnings, and especially when the hourly earnings cross the 3% zone. So if you look at this 3% hourly earning year-on-year rises as a threshold, essentially beyond that, hourly earnings have been correlated with high core CPI. So I don't agree with the Fed by saying what they think as a labor market not contributing to core CPI, CPI as a whole. But falling energy prices could essentially offset this rising hourly earnings. And I think that's what the Fed is kind of hoping for. So in terms of policy, the Fed has dodged the question about tariffs, incoming policy change, government changes, and the election results, etc. They want to cite independence, and they don't want to front-run any policy decisions. They will only incorporate the policy measures in their modeling once they know for sure what the implementation will look like and the exact timing. But we can go through this ourselves. So tariffs, if you have a blanket tariffs across board, it thinks your imports will become more expensive. So that is inflationary by design. Tax cuts is expansionary for the economy. So which means there's higher earnings per share for companies, high free cash flows post-tax, and consumers have more spending power. Therefore, they have higher disposable income and buying more things, etc. So all of that should drive inflation higher. And in terms of the labor market, so I think Trump openly said that he's going to deport illegal immigrants. But I think depending on whether the rules for immigration as a whole become stricter and how many illegal immigrants already in the shadow labor market that's not on the official register, etc., that could pressure the labor, that could tighten the labor market, actually, and that would also raise the cost of labor, which again, if passed on to the cost of products and services, should have an inflationary impact. As we just saw in our previous chart on the CPI versus hourly earnings. So all of that should suggest a high inflationary environment, which in turn should suggest high yields. And the worry is that if the Fed may no longer be able to target a maximum employment environment versus price stability. So far, because immigration accounts for 20% of the US labor market, it has actually held a very strong labor market in terms of labor supply meeting the demand and therefore maximum employment. But if the immigration rules become stricter, we might be able to see labor market further soften, but without the benefit of lowering inflation at the same time. So the Fed might get caught between the two mandates. And overall, I think we want to, the intention is to avoid the high budget deficit. But I'm not really sure if it's avoidable. And generally speaking, I'm quite neutral between the Democrats spending and Republican spending, because if you look at the records of the past two governments between Trump and Biden, they spend an equal amount of money essentially. The politicians have very little willpower to reduce spending. This means higher long end bond yields, and a lot of investors essentially dumping their long duration bonds in favor of shorter durations. We have a trade setup in TLT, and I'm going to think about whether I want to hold on to it once the price improves. High budget deficit, higher inflationary pressure, and high longer and bond yields, not exactly consistent with rate cuts. I think what could happen is that the Fed may slow down, and actually they may pause their QT first. So the QT is still running at the moment because the Fed believes there's ample reserves, bank reserves. So the funding costs are not an issue if they reduce the balance sheet. But I think that is a low-hanging fruit they can stop. They can stop QT, which means they can maintain the same balance sheet and treasury purchases as the old treasuries expire, so they can renew their purchases. So that should hold bond yields a bit lower. And at some point, they may actually have to step in and buy the longer end bonds themselves to prevent a market crash in long end bonds if the US government starts issuing too much. And that's actually basically the scenario the investors are really worried about, is that if the Fed is unwilling to expand the balance sheet again with the QE, then there won't be sufficient buyers of government bonds with the supply essentially flooding the market in the longer end. So after yesterday, essentially the rates market didn't really do that much after Powell's press conference. We still have 3 cuts pricing for the next 3 meetings, but the December one, I think, is in a slight doubt. It's not fully priced in. And if you look at for the next, for 2025, essentially only 2 cuts are being priced in. Terminal yield is now 3.7%, a full percentage point above 2.75% back in just before September FOMC. So the market is sticking with a higher yield. I think the yield curve is consistent with the high inflation narrative, but if we do get a recession, as many indicators like the sum rule and yield curve inversion, etc., are suggesting, then this yield curve is essentially too high. And we've seen the bond market swing quite a lot back and forth between pricing in, loads of cuts in 1 year or nothing at all. And I think now we're towards the tight side of the pendulum. Sorry, this should read 3.7. And I think there's every chance we should go lower if we are seeing recessionary indicators. SPY. SPY, I always maintained a bullish outlook, even though people were getting a little bit fidgety over here in late October. And my target for the near term is actually 620. So I think 600 was always within reach. And my 620 was the target I've had for a while. And beyond 620, I think we could get a pullback from here. And that would just be a standard pullback. It could kind of upset a lot of bulls, people who probably who are chasing over here or removing the shorts, and people thinking that the top is in. But I do see one more leg after that to end around 640. I don't think we might not be able to get here before year end, but we should get here. I would say in early 2025. QQQ. So with QQQ, again, I think QQQ is playing catch up to SPY. It's only just made above the all-time high after the election. Now I think we're closing towards this resistance at 530. And if I'm just looking at the way this has played out, and I think 530 is essentially the near-term resistance, and after that we can pull back by anywhere between 30% to 60% of this move in the wave 2. So I've just got 50% as a market. We'll have to see the exact structure after that. Again, I think the setup is very similar to SPY. We're closing the near-term resistance soon. We get pullback and up we go towards year end and beginning of next year. So nothing, I haven't changed those levels actually for a while. So not everything has been moving in within our expectation, which is great. We just continue to update once this resistance level is hit, and we can see where potentially the reversal becomes. TLT. So TLT, this fall below 90 was actually on the high side, as in the move was on the high side. If you just look at the whole 5 waves down, and getting to this 2.382 extension of wave 1 is still reasonable. I think it's still reasonable within the whole 5-wave structure, but below this would be a quite big stretch for me. So I think over here I would expect, we had a bounce, but I would expect a further bounce from here to get, at least to construct a wave B bounce. And I think because we had a 5-wave down, I would say that the next bounce price recovery should be just a wave B. I think it's most likely to be a wave B, a 3-wave structure, and then we have another wave C down again. In terms of how is that consistent with stock market approaching a high, I think we've had this carry trade debate for a while, and yields so far have actually helped people putting back the carry trades on and essentially propping up the risk assets in stocks. So lower yields, once we approach this level, could first, we will see headlines saying, oh, recession indicators coming, because now traders are pricing in lower yields, lower terminal rate, etc., etc. People are getting worried about economy or labor market. But actually, it could also be that essentially people, carry traders unwinding again, as they did in August. So, we will, we just have to pay attention and pay particular attention on all this relationship between carry trades and also the relationship between yields and stocks. And what I've found typically is that high yields are quite good for non-consumer stocks, business stocks like Google, even Microsoft, but do weigh on consumer discretionary stocks, and that includes Tesla, Apple, and potentially Amazon. So Amazon is kind of AWS has a big part, but also is obviously a very big consumer company. So the relationship between yields and certain sectors of stocks is quite nuanced. We just have to pay attention to how these things work together on an individual basis. So just to recap, I do expect a bounce here. How big a bounce? I think anywhere between above 94 to 97, and even potentially 98. And then I think we should get a C wave pullback again. And I will decide once the price recovers over here. I think I will have a better sense of whether we are going to take this trade off and exit this trade completely, or we should stick to our original stop level. So Tesla, all right. So Tesla has been, so we had the first A wave move from earnings. And essentially the problem with Tesla as a fundamental analyst is that very expensive for a car company. If you're looking at where, General Motors and Ford are getting priced is about a third of the market cap in terms of valuation. So Tesla, that means 2/3 of Tesla valuation rests on the future of robotaxi. Essentially, that is the biggest one right now. The robot humanoid will be Optimus production. That's still a decade away, I think. So we won't worry too much about that. It's the robotaxi that is really important. And Musk essentially forecasts they will be on the road in Texas and California next year. Trump winning the election has removed a lot of regulatory pressure on all of Musk's companies. That includes Tesla, SpaceX, and even X, Twitter. And for robotaxi, which is what we care about for Tesla, that could reduce the regulatory pressure on the federal level, at least, in terms of robotaxi cars on the road, and could speed up clearing those hurdles for Tesla and getting Tesla to run in more states in the next 4 years. So I think, of course, Elon Musk ultimately is a businessman, so he's done this calculation to figure out that even if Harris wins and he supports Harris, it doesn't really matter. He's not going to get favors, whereas Trump could be a game changer for his empire. So that remains to be seen. So we had a rally in the earnings and another rally after the election for Tesla. And I think this stock will continue to be hot in the next few months as Trump actually steps into the Oval Office. What I think here is that we've crossed this, we're reaching this crucial level of 300, which is the high from 2023. So I think this is a quite important psychological resistance zone. I mentioned this to our private group channel on Slack before the price action unfolded. And I think we should get some sort of a pullback here. I think on the balance, we probably won't get a very big pullback. What this retrace would be essentially is the handle for the cup and handle, essentially. If you look at this 2003 high to 2004 April low, and now back to this high at 300, we've just formed the classic cup formation. We should get a handle pullback, and then off we go. And to be honest, I have a really high target for Tesla as a whole, but this is still early days. We will, B could be shallower or deeper, etc. And we just have to play the chart as it unfolds rather than trying to run too far ahead of ourselves. So this is Tesla's historical performance, and these are all the days where Tesla has popped by more than 10% on one day. It happens quite often, a lot during COVID, and then more recently this year. What we've seen is that generally day one after the pop, price is quite constructive. People are still chasing the stock. And day two and day three, there are some pullbacks, and I think things are not as. So I think there's natural consolidation. So that kind of that is consistent with what we've said in the technical analysis. And then for day 4 and day 5, we see a sort of investor getting back in again. So overall, I would say on the average, the next 5 days after a big pop, the price action is actually quite constructive. But there are fluctuations in between. So we have strong day 1, and then small dips in day 2 and day 3, and then price recovery in day 4 and day 5. Now, looking at Microsoft. So we have a trade setup here. And previously, I didn't get enough of a structure to map out how we can get to this ultimate wave C target near above 600. We're still actually quite early because we haven't cleared above this wave A high or wave B low. So there's still a lot of guesswork here. But I think just looking at the way we've rallied and then dipped, it is quite clear it's an ABC here and the ABC down. And I think we at least have a bounce in the C wave to test this high of 470. And then that should complete wave one. And then wave two, pull back anywhere between anywhere between 30 to 70% retrace. And then up we go to wave five. So once we have a wave two pullback, we are much more confident about the path ahead. But given where we are now, essentially, I think it's okay to come in and trade this setup already. Also, the volume has been piling on in this region, in the low 400 region. So it provides a lot of support over here, just below our price entry. So if we are wrong, and we may well be, we stop out after a 9% loss just below this wave B low. But if we're right, we can capture 35% upside. And if you're patient enough, you can capture even all of the 5 waves, 46% upside. So I think the risk reward is there. Therefore, I've opened the trade. Both Microsoft and Google have supported the Democrats, but Microsoft on balance has been more muted and has less influence on things like search results and social media presence. So compared to Google, so this essentially puts, I think, it has slightly less pressure on Microsoft in terms of the Trump retaliation. I think Google might be the #1 target for Trump if he wants to break up the big tech. So I would say Microsoft is more expensive than Google, even though it's about fair compared to historical valuation, its own historical valuation. But Google faces significantly more regulatory pressure from Trump or from the DOJ. Apple, I'm quite bullish on Apple. So Apple hasn't really grown for a while, although its growth has picked up in the latest quarter. And I think Warren Buffett has sold. But interestingly, all of the shares that Warren Buffett dumped has been bought back by Apple's management. So Apple has a stock repurchase program running, and it can still afford to buy at least another $90 billion of shares. So essentially, Apple's price has not really risen because of the valuation, compelling valuation or growth trajectory, but because the repurchase program. And I wouldn't stand in the way of that. And you've seen that Apple actually has delivered wonderful returns for shareholders despite poor business results. So I wouldn't. It's not a stock that actually trades on fundamentals as much as people probably think. Trade tariffs, etc. So high interest rates is a headwind for Apple in terms of consumer discretionary products. But if we see a bounce in TLT or a retrace in yields just in terms of technical adjustment, that could provide some upside for Apple. And in terms of tariffs, imports, and China trade war, I think a lot of that may have been priced in because China already has been critical of Apple generally, the government, and that has been a known headwinds. The tailwind, however, is the market impact of the latest Apple intelligence release as a software upgrade that was only released last week. And that is being rolled out to English-speaking countries, US, UK, Australia, Canada, New Zealand, and it will be released in localized languages over the next 2 quarters. So I think there could be potential tailwinds coming from that side. And actually, looking at Google results, I think Pixel did pretty well because they've incorporated Gemini into their devices. And Apple is actually falling behind. So it's time to play catch up. And I do see Apple going high in terms of stock price potentially from here. I could be wrong. And if the price falls below 200, below 195, I'll have to reassess the chart potential. But overall, the chart presents bullishness, even as if the fundamentals are not fully supporting it right now. Amazon. So Amazon, Jeff Bezos sold at $200 market gain before election, and that upset a lot of people on X. But I actually think now we've broken above this 200 level. It's a pretty positive signal that maybe Bezos is out. He's finished. He's done selling. So it's perfectly normal for a founder who's retired wanting to sell, especially given how well the stock performed within the past year. Now I think Amazon has permission to go towards high 200s, and I'm writing up the fundamental analysis now. It has been delayed because of the key events this week. But if you think about Amazon as part AWS and part consumer with two separate valuations, in combination, they should be worth about $230. So right now, slightly, not massively, but slightly undervalued. I see Amazon as with decent upside from here. I'm just kind of waiting for a retrace. Once now we've gone past 200, it should retest that 200 level, and even here in the wave 2 pullback, and before we complete all 5 waves of this wave 3. Google, I think Google could have gone much higher if Harris won, but actually the market is still done pretty well since post-election. And essentially, this move is now reflecting the post-earning pop that was getting reduced going into the election. In terms of risk reward, so I've got wave 3 at 270 level. It's not a bad level now in terms of getting in. Just not quite enough strong risk reward for me. I mean, you can put a stop over here to represent better. But because this bearish alternative hasn't really been cleared, there's always a chance that there's a wave C. I really want to see a price correction, near-term pullback to get in and use this wave 2 low as a stop, just in case this is actually wave A and this is wave B and this is wave C, then we can save some money. So I'll prefer to get the pullback. And also here, given the volume profile here, this is a heavily supported zone. So it's much nicer to buy just above this VWAP versus this volume profile versus chasing a higher here. But that's more like a personal trading style, and not everyone, of course, has the same risk profile. Meta, it fell by around 2%, and actually on the election day, and actually that really just completed the wave 4 low with the ABC here. So to me, that was a wave 4 pullback completion, and now up we go to wave 5. There isn't really a lot of upside to meeting this target. Meta obviously has been a very bullish trend since a couple of years ago, and we're probably in the final innings of the larger trend. And I think once we get wave 3 target, we should see a wave 4 pullback back into 550s. And I think I'm ready to enter with a target of 700 plus in mind to finish off this wave 5 and 5. So again, not enough upside for me here. It's been a bullish stop we sort of missed it, but you can't win them all. So I'm just gonna wait for a better entry. NVDA, very bullish, having cleared that 140 high from June. And then you can see this as a double bottom or wave 1-2 setup. We're now moving the part of wave 3 of this 5. So I think the wave 5 target could be over 200 or even 240. CRM, I have now removed the bearish path, which I had before. So there was a chance that this is the ABC pullback. And the reason for that expectation is because this wave 2 is quite shallow. for wave 2. But now we're approaching this high again from Feb 24. I think I'm ready to essentially remove the bearish alternative and say it's now moving towards wave 3. We don't have enough of a structure to map out exactly how this wave 3 unfolds. We want to see a move higher, a pullback, and then we can map out how the extensions from here. But overall, I would say I expect this large degree bracket wave 3 to be above 700. So if you have if you want to do a long-term trade, and I think this will be multi-month or at least 1 year plus, we can enter, if you want to enter now, and put a stop below the 200 level, below this VWAP. It's still pretty good risk reward, but you have to be willing to lose 30% here. And that maybe means smaller, a smaller trade size. So your stop loss isn't too hurtful to your portfolio. Or if you want, you can wait for more clarity on the micro setups within this wave 3, and we can capture more short-term trends from here. ADBE is essentially been bouncing between those two VWAPs. And this VWAP here is from the September low of 2022. That's been very supportive of the overall pricing. The VWAP here is the high from September 2024. So what we're saying is that ADBE is above the long-term trend, long-term price trend. And we're actually very close to it. So that provides plenty of support here, as long as this, also this volume profile. But we're kind of stuck just above this short-term price trend, this short-term VWAP. So if you bought long-term, the investors who bought long-term, they're all in profit, but people who have bought in the past 2 months, they're underwater. So that's why we're seeing resistance here. So people who bought in the short term, they're thinking, I've got better trades elsewhere. Everything has rallied since the election. Why am I stuck with Adobe? Let's get out and trade other stocks. And that's a very realistic trader psychology. So we haven't got a definitive breakout either side or breakdown either side. So I think if you are quite aggressive, we can get a trade in here and just put a VWAP stop below here and target this wave 3 level at above 300, 700. You can even widen the VWAP to something like below this red line, which has been very supportive of the longer term trends. So that's pretty nice, 3.5 risk reward for this setup. Or if you're more patient, you want to wait for the confirmation signal, you can wait for this breakout here, the retrace, and use this C as a low and play the rest of the wave 3 here. So the risk of entering now, obviously, is that it just can consolidate for much longer, and it's the opportunity cost of not buying other stocks, essentially, in this environment. Netflix, we had a decent earnings, which I covered in the last previous video. Now I think we're in the wave 3 resistance, which is a 1.618 extension of wave 1, and I would expect it to pull back essentially anywhere between 580 to 650. In up market, this pullback might get quite shallow to 650, but I think we can start buying in between those two levels and target just above 950 for the final wave 5. The Citibank is one of my predictions for a Trump win. Essentially, the banking sectors in terms of, should receive favorable deregulatory tailwinds. So that means lower reserve requirements, etc. And there could be winners under the Republican regime. What could be a headwind is, of course, the Fed's rate cut cycle, which reduces the yields that it can receive on its loans. So generally speaking, lower yields is bad for bank stocks. But given what we said in the first part of this webinar, we could be entering a higher for longer regime because of high inflation expectation and high long-term bond yields. So maybe the impact of lower yields is not as bad. So we have a trade that I'll foresee already, and I expect us to take profit around 100, and it's moving quite nicely since we entered the setup about 10% now. I still have this stop here just under the red line, so I could have a trading stop using this red line below the VWAP, and that would make sure that we at least capture some of the upside if the price action retraces and reverses. GLD, so I think generally speaking, higher inflation, higher budget deficit would push people towards buying more gold, and high political tensions too. And I think the emerging market central banks are not done buying, even if they have slowed purchases recently. And also there's tailwinds from North American and European ETFs that have been behind the curve in buying gold. A lot of the ETF flows have happened in Asia, but not in the US and Europe. So right now, I think because how fast and how far gold has risen, I do expect a pullback, but I don't think the entire cycle is done yet. I think this entire cycle is done when the ETF inflows have surged to record highs and retail are piling in, and then also emerging market central banks continue to decouple from the dollar and switching into gold and potentially even silver. I think Russia is even considering silver now. Silver, the same, is broken below this upward channel from here. We took profit just around this high, which is quite rare to be so precisely correct in terms of timing. We won't be able to repeat that trick every single time, but now it's now testing this VWAP that since the August low. And I think we potentially could have a bounce and a breakdown here. So like an ABC correction, wave 4 retrace for the wave 4 retrace, and then head higher again, wave 5 with gold. Bitcoin. So previously I had this as a C stop, and this is C equals a perfectly normal termination zone for C, wave C. But the problem I have is that if this is a wave A finish and a wave B pullback, as opposed to where I have marked now, then this pullback really is very, very shallow. If you say this is the entire trade finishing, this pullback is only a 23% pullback of this entire move. And of course, we're in a bullish environment for Bitcoin, and Trump has just won. But it does make me think that perhaps Trump winning the action we had in the past couple of days was actually the termination of wave A instead. In terms of technical analysis, both of those C terminations could be valid, but I do have a sense that perhaps we're expecting a bigger pullback in B, and just looking at how, because we're in wave 5, and usually wave 5 takes a similar extension to wave 1, and if you just look at how wave 1 unfolded, so if you look at wave 1 here, we also had a shallow pullback initially over here that was just 23% pullback, quite shallow for B pullback, popped higher, slightly higher, and then we had a much bigger pullback in B, which is a 50% pullback. And that provided a healthy backstop for this wave C leg higher. And if you look at from the bottom to wave A, it's about 60%. And if you look at today, if we mark the C completion today, this move from the bottom to this wave C is about 58%. So that would be much proportionally similar to how things unfolded in wave one. Of course, history doesn't always repeat itself, so we can't just take this as, saying this is the past is exactly what the future. But at least the possibility is still on the table. So over here, I really want to see how the price action unfolds. If we have an upward move directly further up from here. So if let me just explain what I'm thinking. So if we're at a wave A, B, and wave C, if we travel much higher from here, then let's say to the 1.618 extension of this wave A at the wave B low, then maybe the wave B pullback is already completed, and we have to start fresh in terms of mapping out this final leg. So there's not a lot of clarity right now, and I would essentially just wait a little bit for further confirmation. Ether rallied as a catch-up. We've been predicting this catch-up for a while, and it finally happened after election. And in terms of levels, we have an ABC, large degree ABC target, just above 3,000. And actually, that's manifested for wave C as an ABC as well, or over here. And what we have now is essentially Ether approaching resistance towards 3,000. And we have wave C already at equal length, wave A over here. And if we get to the 1.236 extension of wave A, then there's just 3,100. It could settle anywhere inside this blue zone. And I do expect a overall retrace, or pullback from this move. And actually, that would time things quite well with a Bitcoin retrace, from what I see here. Longer term speaking, I expect Ether to get to, it depends on how far we pull back from wave 2, and we can get above 5,000 for Ether. So still a long way to go. And on that note, I've been using Coinbase as a proxy for Bitcoin and Ether trade. And actually, that's a quite common way of using it. So the reason MicroStrategy trades at 3 times the NAV of its Bitcoin holding is because a lot of funds don't have access or the permission to buy ETFs like IBIT or underlying Bitcoin. So they have to look for stock proxies. And miners have been poor because of their poor economics and high volatility, have been not as good a proxy for Bitcoin as MicroStrategy has been. And I think Coin is now, because MicroStrategy has now become so expensive, investors now looking at Coin in terms of proxy holding as well. And Coin would generally benefit from 2 things: higher transaction volume from higher Bitcoin and Ether price, and as well as alternatives like Solana. So Solana is a big percentage of Coinbase platform now. So all of those cryptocurrency rallying is very supportive of the transaction fees that Coinbase gets. Also, Coinbase also holds its own Bitcoins. And finally, Coinbase is doing share buybacks to the tune of about 1 billion. And I suspect that they did that over here, just November the 1st, when Coinbase actually outperformed Bitcoin on that day. And if you just look at the pop, 31% on the day, on the post-election, that is the biggest single day increase in Coinbase's history. And in terms of standard deviation, it was 5 standard deviation daily move compared to its average move versus 2 standard deviation for the miners. So there was a big volume investor interest buying into Coin, using it as a proxy for a cryptocurrency holding. And I do think we could get a pullback here, given how far we're now meeting this resistance trend line from the March 25th high. So we're stalling at this resistance. I expected this to fill out, but now we're stalling here. We could get a pullback And that would really align with what we said about Bitcoin and Ethereum. And then before it has break above this thin line, gets higher towards 400, mid 300 to 400 level. So because given how fast and furious this pop is, I've adjusted up my target levels technically for coin. And to be honest, it's not clear how, again, because we're in a bull market and the sentiment is very strong, it's not really clear how shallow this retrace could be. So it could be anywhere between 195 to 220. So I think it really depends on your risk tolerance on how aggressive you are in buying this rally. So basically, I think there's more upside after retrace, but the wave to pullback is unclear right now. So I think that's it for me today. So thank you for tuning in. Any questions, ask me on Slack, and happy trading, and have a wonderful weekend if we don't speak again. Thank you.